Welcome to the Pro Tickers Deep Dive, your go-to breakdown of the stock movers and major stories at the close of global trading. Let's dive into today's market action. Today, we're going to unpack quite a wide-ranging discussion, really looking at current market dynamics. We'll be focusing on bond trends, investor behavior, and some, evolving economic signals. So let's start with the bond markets because there seems to be some optimism building as Q3 kicks off.
Yeah, definitely seeing that. Q3 started pretty strong, actually. Signs of yields coming down, prices going up, and fixed income.
It feels like investors are thinking, maybe, that the window for those really high yields might be closing.
Exactly. There's a noticeable shift, folks moving out of cash back into bonds.
And we shouldn't forget that huge amount of capital still parked on the sidelines, right, in money market funds.
Oh, absolutely. Massive potential fuel there, just waiting. What's interesting, though, is how this differs from equities.
How so?
Well, earlier, we saw domestic equity money moving towards Europe, but the bond market, not really seeing that same shift. International investors seem still pretty engaged with U.S. debt. They like the U.S.-denominated stuff, but they are hedging the currency risk.
Interesting. So global players are still really keen on U.S. debt, just being careful with the dollar exposure.
Precisely.
Which brings us nicely to currency and safe havens. The U.S. dollar is down quite a bit this year, nearly 10%.
That's a significant move. Pretty rare, actually.
Most people seem to see it as a correction, right, from being overbought. And they expect maybe more downside?
That seems to be the consensus, yeah. Which naturally leads people to look elsewhere for safety.
Like gold.
Exactly. Renewed interest in gold has definitely been sparked by this. And, it fits into this broader theme of where investors are finding stability now.
Right.
There's a pretty strong agreement, it seems, that high-quality fixed income and precious metals, like gold, offer a solid hedge right now.
So not just bonds, but gold too.
Yes. And we're even hearing reports that central banks, wealth managers, they're apparently increasing their gold exposure.
Wow. That's a huge move for gold.
For stability, sure, but also as an inflation hedge.
Okay, so back to bonds specifically. How are the big institutions positioned?
Well, looking at institutional positioning, long-duration bonds seem less popular right now.
Those are the ones really sensitive to long-term rate changes. Yeah.
Correct. Outside of pensions and insurers who often need them, there's less appetite. But intermediate duration debt, that's still pulling in flows, especially from total return type investors.
Gotcha.
But that lack of strong demand at the long end, it's probably temporary.
You think so?
Yeah, the expectation is that once policy rates start coming down, interest will pick back up.
No, makes sense.
When short-term rates fall, you'll likely see steeper yield curves, which makes longer-term debt more attractive again. It should draw capital back in.
So patience is key there.
Pretty much. It's about waiting for rates to, normalize somewhat.
And that brings us to the broader economic picture, this idea of returning to a more, quote, normal environment.
Yeah, where capital actually has a cost again, leaving that zero rate era definitely behind us.
So what does normal look like now? Expectations are for policy rates maybe settling around, 3-4%?
Somewhere in that ballpark, yeah. And long-term bond yields may be closer to 4-5%. That seems to be the thinking. And it's interesting, despite all the talk about rising U.S. debt and fiscal uncertainty, there doesn't seem to be much real fear among global buyers about the U.S.'s long-term creditworthiness.
Really? That really puts things in perspective.
It does. Buyers aren't ditching U.S. government securities. They're just getting smarter, more nuanced with their hedging and maturity strategies.
Okay, so confidence holds steady there. What about investor behavior? Retail versus institutional?
We've definitely seen a surge from retail investors back into the markets.
And using margin more, I hear. Borrowing to invest.
Yes, there's an increase there. Meanwhile, the institutional players, the big money, they seem generally more cautious.
And earnings season's coming up. Any expectations there?
There's definitely some talk about potential upside surprises. Expectations are maybe a bit subdued, which connects to this whole melt-up scenario people are talking about.
Right, the idea that prices could shoot up fast.
Exactly. If earnings come in strong, better than expected, it could fuel rapid gains, not just based on fundamentals, but on positioning and momentum.
And institutions that stayed cautious might feel forced to jump back in.
That's the theory. If earnings beat, those sidelined institutions might have to chase the market higher, adding more fuel to equities.
Okay, market resilience on one hand, but what about the consumer? Are we seeing pressure there?
We are. Despite overall resilient performance, the consumer is definitely getting more selective.
Focusing spending on, Holidays and big sales events.
Seems that way, yeah. And persistent inflation, that's still a factor, especially thinking about tariffs, seasonal goods. That might become more obvious in the second half of the year. So, wrapping it up, as we look ahead, the really critical factors driving
What
things,
should we be watching most closely?
I would say it boils down to three main things. Consumer behavior, definitely. Any surprises in corporate earnings, positive or negative. And naturally, what the central banks decide to do with policy, those are the big levers.
So what does this all mean for you, the informed observer? It seems the market is navigating a complex shift from a dollar correction to a renewed appreciation for traditional safe havens like gold, all while anticipating a return to normal in bond yields. Keep an eye on those earnings reports and consumer spending patterns. They're the wild cards in the coming months. Thanks for listening, and we'll see you next time on the Pro Tickers Deep Dive. Stay sharp and stay informed.